Okay, now we're gonna start with the third method, that is the payback period. So this is quite simple. It's just plus, minus, addition, subtraction, and then you're done. More precisely, it's just gonna be addition of the cash flows, and then you get your payback period. So before we jump into the depth of this thing, let us understand what is the meaning of this payback period. Payback period means the period of time that the project requires to recover the money invested in that project. Okay, it's simple as that. It is the time period needed for the to recover the investment made in that project. Okay, that is, you take up all your cash inflows which are going to come in the future, and then you compare it with the investment value, and at which point of time you have your entire cost recovered. That is your payback period. It's simple as that. No discounting factors, no present value, no such stuff like that. Okay, the payback period of a project is expressed in years and computed using the following formula. Payback period formula is investment required for a project divided by the net annual cash flows. Okay, investment required for a project, that is the cash outflow, divided by the net annual cash inflow. Now, as I said, unlike the net present value method and IRR method, payback method does not consider the present value of the cash flows, precisely present value of future cash flows. Under this method, your investment is going to be accepted or rejected purely on the basis of when the money is going to be recovered, when the investment is going to be recovered. The acceptance or rejection criteria is basically boils down to this thing. Payback period is less than the company's expected payback period. Sure, go ahead, accept the project. Now let's see an example on this thing, and also after that we'll have two different scenarios. I won't disclose it right now. Once we complete the payback example, after that we'll go ahead for this two different scenarios. So here we have an example on payback period. Okay, so let us say ABC company is planning to purchase a new machinery. The related details of the cash flow is as under. Okay, the company's desired payback period is 4 years. Okay, so initial cost of machine, that's gonna be let's quote it to say somewhere around $40,000. 40,000. Annual cash flow details. Sales will be increased, or you can say sales will be 80,000 supposingly, and cost of materials say around 10,000 of outflow. Cost of materials, salaries another $20,000. Maintenance of the machinery another $5,000. Yeah, pretty much that's it. So we can say annual net cash inflow will be equal to $45,000 annually. Okay, but wait a minute, compared to this, the initial cost of the machine is very less, right? Let's say the sales is going to be only about $50,000. Yeah, that makes sense to us now. $50,000. So the annual net cash inflow is going to be $15,000. Notice one thing over here, we have not taken depreciation of the machinery account. Why? Because that's a non-cash expense. Actually, cash is not going to be spent for booking a depreciation. So here, all the non-cash expenses and incomes are avoided over here. So if you remember the payback period formula, here formula, that is your investment required for the project, that's divided by the net annual cash inflow. Perfect. Let's get this done. Oops. So now it makes sense, right? Payback period is equal to investment required for the project divided by the net annual cash inflow. That's the payback period formula. So over here, first we need to compute the net annual cash inflow. That is step one, which is covered over here in the question itself. Ideally, we framed it over here in the question itself, or else you need to compute it. That's pretty straightforward, as you have seen already. So here we have the net annual cash inflow of $15,000. Investment required for the project as $40,000. So here we have $40,000 divided by $15,000 equals to how much? 2.67. Ideally 2.7 years. So that's, yes, that's less than the 4 years. So to conclude, the payback period is 2.7 years, which is less than company's desired payback period. Therefore, the equipment should be purchased. Okay, so that was all about payback period. As easy as it could get, guys. There can be nothing simpler than this one project evaluation technique. But there are certain limitations in this method also. It's that many times it happens that projects or the investments gives a high return after its initial gestation period is over. Like in this case, it might be possible if the machinery will have generated an annual cash inflow of just say around $5,000, or you can say if it was the other way around, where we'll just see over here. This is not for the final sum, just giving it as an example to explain the disadvantage of this method. Let's say the machine would have costed annual sales of just $30,000. Oh my god, why am I making so much mistakes today? We'll make it to $38,000 precisely. So now if you look at this period of payback period, it's going to be 40,000 divided by $3,000. It's going to be 13.33 months only, guys. Okay, 13.33 months. That's way beyond the company's desired payback of 4 years. In this case, definitely the project would have been rejected. But let's say the company failed to realize that this machinery, once the labor would strained in this thing, and over the coming years, the cash inflow would have increased. The sales value from the fifth year might have picked up and doubled literally. In that case, the machinery, this method fails to track all the cash inflows arising after the payback period, and that's the main disadvantage of this thing. Another disadvantage is that it does not account for the present value of the money. I'm sorry, just fumbling a bit. This method does not take into account the present value of the future cash inflows. Like $15,000 coming after the end of the first year is not going to be the same it's not going to have the same value as it had at the beginning of the year. $15,000 at the end of the third year definitely won't be the same as in value it sits today. So these are the major two disadvantages of this method. The present value disadvantage is taken care by the discounted cash flow analysis, which is our next method, of course, to study. But yes, this disadvantage of ignoring the cash inflow occurring after the payback period is over, after the payback period, is definitely a biggest flaw and cannot be rectified for this method. So remember, I had told there are two more things coming up for this particular thing, particular payback period method, which I'm going to show you after the example. Now that is, over here, we had the understanding that the annual cash inflow are going to remain the same. What happens when we have to choose from several alternatives? And next is that payback method under the cash flow method, under uneven cash flows basis. So as the situation arises, you need to make a choice among the different payback, apply the different methods of payback as per the situations. We're going to quickly look at this two methods or two situations where precisely cash flow from several or choosing from the several alternatives and payback method under uneven cash flow. I'll just try to portray this, or you can explain this thing with the help of two quick examples for this thing. So let us say choosing from various alternatives. This is also as simple as it could get. Suppose ABC company wants to buy a machinery and has two equipment choices. Let's say machine X saves $2,500 in labor and costs $15,000 to purchase. Similarly, we can say machine Y saves $3,000 in labors and cost $19,000 over here. Okay, so to compute the payback period over here for machine A, or you can say payback period is equal to the net annual cash inflow over here will be equal to the savings done by the machine. Okay, any avoidance of cash outflow in this case is as good as a cash inflow only when you're computing this payback period thing. Okay, so over here payback period will be equal to your investment for the project, investment divided by net annual cash inflow. Over here we're going to compute for machine X and this will be for machine Y. Okay, sounds good, right? So here it's gonna be $15,000 divided by 2,500, which is equal to 6, right? 15,000 divided by 2,500, 6 years. And similarly here it's gonna be 19,000 divided by 3,000. So it's gonna be equal to 19,000 divided by a little over 6 years. So obviously machine Y will be rejected and machine X will be procured. Okay, decision accept, reject, as simple as it can get, right? So this is how you determine which one to choose, which one to drop off. Just compute the payback period for every individual projects or purchase or whatever investment decision you need to make, and evaluate the shortest payback period. The condition over here is that if the company would have put it one more condition that the company's desired payback period is 4 years, then in that case both the machineries would have been proposals which have been rejected and neither of them would have been purchased. Now the other is payback method under uneven cash flows. So here we're going to put a line saying that this is over, and now we're going to pay payback period under uneven cash flow. So till now, whatever methods we have done, we have assumed that all the projects are giving an equal cash flow throughout all the years, but that does not happen generally, right? As in how the labor gets a good hand, as in how the labor gets trained on the new machinery, as in how the expertise is developed, economies of scale and various factors are achieved, the cash inflow goes on increasing or the cost goes on decreasing, or both of them take place, which happens to generate a uneven cash flow, higher in the initial years, lower in the later years, lower in the initial years, higher in the later years. Anything is possible, right? So let us look at an example where there's an uneven cash flow. Let's say an investment of $300,000 is to be made, and the cash inflow on annual basis are as mentioned, right? So for years and the annual cash inflow, you have year 1, 2, 3, 4, 5, 6, 7, 8. It's fine. I think till 8 years should be enough. For the year 1, we assume it to be on the lower sides. Let's say $30,000. Year 2 will be like, no, not too much of increase. $32,000. Year 3, let's say it's gonna be remain the same. Year 4, we're gonna have an expedited one. $38,000. How much is total so far? It's 132. Now we can bump it up to somewhere around $50,000, $55,000. Let's say there was a shortage of materials and we had a negative cash flow or reduced cash flow. How much does this give? $289,000. And here we have something around extremely on the higher end, $90,000. So now we got to compute the payback period over here. In this case, compute the payback period for the investment. If you see, because there's an uneven cash flow on an annual basis, we cannot use the payback period formula as we have been using till now, which is the total investment for the project divided by the net annual cash inflow. What we can do is we're going to use the compound or cumulative cash inflow approach over here. So we're going to compute the, oh wait, why am I writing it? It's already here. We're going to compute the cumulative cash inflow. Compute the cumulative cash inflow. I think it's getting too long, guys. Just hold on a while. We're just nearing the end. Cumulative cash inflow, which is going to be previous cash inflow plus the current cash inflow, and we're going to drop it down across, right? So it's 30,000 for the first year, second year 30,000 from the previous year plus 32,000 from the next year, that's 62,000. For the third year, 62,000 from the previous year, 32,000 from the current year, 94,000, and so on. Now we're going to see what was the initial investment, or you can say the outflow was $300,000 a week, okay? And here the $300,000 is covered over here when you have $289,000 over here. So it's obvious that the payback period is more than 6-7 years over here. And to be precise, what is the payback period? You can say you need $11,000 more in the 8th year out of its receipt of $90,000. So that's gonna be $11,000 divided by $90,000. That's gonna be 12 months. Okay. So your payback period is gonna be 7 years plus 12 is equal to 7.12 years. Your payback period is 7.12 years, and obviously you're going to reject the project because it's far beyond the company's desired rate of return of desired payback period of 4 years. This is all with regard to payback period, guys. I hope you had a good understanding of the payback period. As simple as it can get, as easy as it can be, once you have understood the principles of its application, right? I'll see you in the next session where we're going to study the discounted cash flow analysis. Now we're going to study the next method, which is an extension to the payback period method, that is discounted payback period. So far, you must have realized that discounted payback period has one of the biggest limitations, that is, it does not account for the present value of the future cash inflows, which is highly an inappropriate technique to judge a project, right? That limitation is compensated, or you can say that limitation is eliminated entirely by using the discounted payback period method, or you can say the discounted cash flow analysis. In the discounted payback period method, you eliminate, or you can say you eliminate the payback period flaw by discounting the future cash flows appropriate values to the appropriate values. Now that discount rate will be the company's, if it's not mentioned, if it's not provided to you, you safely assume that it's the same rate of return required by the company for any project. That will be your discounted rate of return, or you can say the discount rate to arrive at the present value of the future cash flows. In discounted payback period method, we have to calculate the present value of each of the cash inflows, taking the start of the first period as 0 point. Okay, the first cash inflow point is a 0 point. That is when you invest, or when you make the cash outflow. That is as happens. 0 point means that the value will be 1. It's exactly the same as we do in the net present value, right? If you recollect the fact how we had done the cash inflow present value computation, it's going to be exactly the same. Challenge over here is that you have to use a cumulative cash flow approach like we had done in the previous payback period method for the last example, where we had an uneven cash inflows coming in at various point of time. Now, the discounted cash flow for each period is computed by a formula, that is discounted cash flow is equal to actual cash flow divided by 1 plus interest rate raised to the power of n, and that is the exact formula for the present value of cash inflows. If you recall the formula which we had done in understanding the present value factors, in understanding the present value computation, that was also present value of future cash, you can say future value of the cash inflows divided by 1 plus interest raised to the power of n, 1 plus rate of return raised to the power of n. That's exactly the same formula which we're going to use for the discounted cash flow over here. Now, once we have the discounted cash flow formula, the entire procedure is same as it was when we were doing a payback period which had uneven cash flows coming in. So that can better be explained with the help of an example. Let's start with the example itself now. Now we have your discounted payback. So let us say an initial investment of let's say $232 400 $232,000, okay, is expected to generate $600,000 per year for 6 years. Calculate the discounted payback if the expected rate is, let's say, 10%. Okay, so first we're going to prepare a table which is going to compute the discounted cash flow of each period by multiplying the actual cash flow to the present value factor. So here we have is let's say here the cash flow scenario over here, present value factor at 10%. You have your discounted cash flow. So here we're going to understand year 0, 1, 2, 3, 4, 5, 6. For year 0, we're going to incur the initial cash outflow of $2,324,000. Okay, and you're going to have an every year annual cash inflow of $600,000 till the 6th year. Now we're going to look at the present value factor table for 10%. For the first year, it's 0.9091. So it's 0.9091. Next year, it's going to be 8264. So it's 0.8264. The third year, it's 0.7513. 0.7513. Fourth year, it's 0.6830. 0.6830. Fifth, 0.6209. 0.6209. And lastly, sixth year, it's going to be 0.5645. 0.5645. Over here, it's going to be 1. Now, as we had done in the present value computation, I want to multiply this entirely. Use the same formula, dollar value. Okay. Now we're going to put the one more additional step, which is going to help you figure out where does your payback period lie. It's going to be cumulative discounted cash flow. Okay. So here we're going to have the same minus figure, $2,324,000. And as you realize, this goes on decreasing because you initially made a negative investment, like your cash had gone out, and then you're starting to receive money against that, which is discounted to the present value. So obviously your cumulative cash flow will keep on reducing from negative and ultimately turn out to be positive. In which year it turns out to be positive is in the 6th year. But it does not need the entire $338,700 of cash inflow in 6th year. It just needs this $49,580. So what we're going to do is use the same equation as we had done previously. That is, we're going to figure out how much is the difference over here. Out of $338,700, we just need $49,580. Right? So we're going to compute the fraction amount over here. That is, the discounted payback period will be equal to 5 years plus $49,580 divided by $338,700. That's gonna be a fraction of 0.15. So it's gonna be 5 years, 5.15 years. Okay, so this is how you get your discounted payback period. It's very easy once you understand the discounted cash flow concept and you start applying it. That's why hence we had told you the present value computation is going to play a really crucial role in all your future computation, most of the techniques of project value evaluation. As for now, I hope you have a good understanding of your discounted cash flow analysis. Okay, that's it for the time being, guys. Now we come to the fifth method of project evaluation technique, that is opportunity cost analysis. So this ideally does not involve much of an intense computation like we had in the present value, discounted cash flow and stuff like that. This is just mainly a understanding, or you can say application of a common sense. What is the opportunity cost to accept a project or reject another project? Okay, so opportunity cost, ideally saying in layman terms, it is the cost of earning income which you forego for choosing the other option. It is the cost of benefits you have lost because you choose the other option, because you went with the other option. In this case of project evaluation techniques, or you can say, before going into the depth of project evaluation, let's understand how do you judge that in the layman's, you can say in today's term. Let's say you have a weekend assignment, a part-time assignment which you can do on your weekend and earn a handsome amount of $1,000, but you choose to go out with relax with your friends. Okay, so here the opportunity cost for you to go out with your friends is $1,000 because you forgot one income and choose the other option. The cost of losing out on that income, that profit, is the opportunity cost for you at a personal level. When you expend some of your, when you and your friends share drinks and have a good time, and the amount you spend on those activities, that's another, that's incremental amount for you, but already you made a loss of an opportunity cost of $1,000. So that's simply as an opportunity cost. So let's look at an example from the project management perspective, and then I hope it will give a better understanding of how do you evaluate the opportunity cost. As I said, this is not going to be a really fancy kind of example where you have a whole lot of techniques, present value, discounting period, payback period, and stuff like that. This is going to be a simple layman question. So let's say we'll look at this example from a, not from project manager perspective ideally, but from a layman's investment term ideally. Okay, suppose you have $200,000 to invest, and you can choose among the following options. Okay, one is invested in government risk-free return scheme, which gives a return of say 5%. Okay, the other is your friend has approached you to invest in his startup, invest in your friend startup, which can give you a return of 12% after 3 years. And you do the same way, you invest in free for 3 years. Okay, for 3 years, and 12% per annum for 3 years. So now here you have to choose which investment option is the better for you, which is not one. The higher the risk, the higher the return. In the case of government risk return, the investment, or you can say the government risk return, does not carry any risk, hence they have the least return at say a normal rate of 5%. But your friend's startup is an attractive one, but also it possesses a high risk. You may or may not even recover the principal amount, or you may recover the principal partially in case the startup fails. Anything is possible. That's why it provides you with a higher return, that is of 12% a year. So now let us see what is the income which you're going to derive with this thing. So here you have your years, and $200,000 invested at 5% per annum for 3 years. That's going to give you an income of, let's say, for the timing, we'll just avoid the whole concept of present value because we're going to try to keep it as simple as possible. So year on year, your friend and your this bank is going to give you some return. We just look at their current values only. For the year one, three on $200,000, 5% gives you $10,000 of return. So for your government, you get, this is for government risk, government bonds. Okay, and now we're going to see your friend's startup option. This is going to give you a 12% return, so it's going to be $24,000 for 3 years. That's going to be $72,000. So here you might say that if you invest in your friend's startup, you're going to earn an income of $72,000, but that's not the case, guys. You're just going to earn an incremental profit of $42,000. incremental income. And why so? Because to earn a $72,000 income, you had to forego an opportunity cost of a $30,000 income. That's how you only earn an incremental income of $42,000 in the long run after 3 years if you invest in your friend's startup. So this is the concept of opportunity cost, guys. When you forego one opportunity, you also need to evaluate the cost of income you forgot by rejecting that option. And when you determine the income you gain by the other investment, you need to understand only what was the incremental income, incremental gain you made on that investment, because you already had to forego a secure, a risk-free opportunity to earn an income. Okay, although not really important from a calculation concept point of view, but really important to know as a project manager which project has how much incremental cost and which project has what opportunity lost, which project loses an opportunity cost to what extent. That will give you a more detailed analysis, a more clear idea of how to choose which projects and so on, guys. I hope this was easy to understand. With this, we complete our opportunity cost concept. Now we come to the last method on project evaluation, that is earned value analysis. Now this method, the intention of this method or using this method is really different from the other methods, other 5 methods. If you notice in all the other 5 methods, our main intention or main focus was diverted on how to select a project. But this method helps you to determine what is the progress of an ongoing project. Should you continue it further? What is the additional investment required? Is it on time or not? And all those questions are addressed by this thing, by the earned value analysis. That's why the intention, or you can say the focus of this method is mainly on evaluating the ongoing projects, not between choosing a project, but evaluating the project which are already being executed. So what is the earned value analysis? The earned value analysis is by definition an industry standard method of measuring a project's progress at any given point in time, forecasting its completion date and its final cost. At the same time, analyzing the variances in the schedule and budget of the project proceeds as the project proceeds. This method compares the planned amount of work with what was actually been completed, and then it's determined if the cost, the schedule, and the work accomplished are progressing as in accordance with the original plan, with the original budget standards. As the work is completed, it is considered as earned. What is the need for earned value analysis? Now, most of the projects are over budgeted and are behind the schedules as most of the time. Also, many times the project finish over and above their initial budgets. And sometimes it happens that even after spending a lot of time and money, projects never get completed. They come to a halt because of some of the other reasons. So it's important that this earned value analysis gives the management an insight, and it helps them in various ways. How does it help them? It helps the management and it helps the project managers mainly to measure the amount of work performed on any project at a given point of time, by which they can forecast the precise completion date and also the precise cost to complete the project. It helps the management to analyze between the various schedules, between the schedule and projected budget cost. Also, most importantly, it enables the management to take a proactive decision rather than a reactive decision when it's too late and the damage is done. So this all boils down to two main questions which are addressed by the earned value analysis. The first is that will the project cost on completion be greater than, equal to, or less than the original estimate? That is the difference between the planned cost and the actual cost. And next is that will the project be completed on time? That's it. This is the main two intention of the earned value analysis. So going ahead, now, to understand this earned value analysis, we're going to need to understand some variances which are computed under the earned value analysis. Now, to understand the variances which we're going to compute under the earned value analysis, it's important for us to know a few important definitions beforehand. Planned value, or the budgeted cost of the work schedule. This is the total amount of work scheduled to be completed as per the milestones which were defined originally. Okay, so you need to interpret what is the actual plan, what was budgeted, or you can say planned value, which was the actual cost which was budgeted to be completed when the work reaches a certain stage as per the milestones which were defined originally. Actual cost, or the actual cost of work performed, this is a total of the cost incurred in accomplishing the work till date. And lastly, we have earned value. This is the value of the work actually completed. Two variances are computed under the earned value analysis. First is the cost variance, and next is the scheduled variance. We're going to look at this with the help of an example that will give us a much better clarity in understanding this whole variance concept. So let's go to the example, and we're going to form it over here. Earned value. Okay. So let us say a project manager has a budget of $1 million, and the project is expected is to be completed in 12 months. Now after a month, 10% of the project is completed and cost incurred is $120,000. Okay, but as per plan, the project should have been completed till up to 20%. So over here we are saying that as per the original plan, the project should have been completed up to 20%, but the actual status states that it's completed only till 10%. Now you're going to need a few important computations over here to determine the variances. So first, budgeted figures and actual figures. Okay. So we have the total cost of the project. It's budgeted at $1 million. Percentage of completion as per the budget. It should have been 20%. Actually, it's only 10%. Now then we have the actual cost incurred after 1 month. It's $120,000. Okay. Actual cost after 1 month. Let's mention it more clearly. Right. Now we're going to compute the important figures which we had discussed. That is the planned value, the actual value, and the earned value. Compute the planned value, actual value, and the earned value. How are you going to compute the planned value? That is the total amount of work scheduled to be completed as per the milestones originally defined. Total amount of work expected to be completed as per the original plan. By here, total amount of work means that work or the cost expected to be incurred. Right? So that's what is the plan value. Oh, so it's gonna be how much? It's supposed to be $1 million to into 20%, right? So it's supposed to be a $200,000 of work to be cost to be incurred and the work to be completed till 20%. Okay, now we're going to compute the actual value. That's going to be total cost incurred till date to accomplish the current work status, right? The current status of the work. I can say the current status, and that's simple. It's given straightforward. That's $120,000. Okay. And lastly, we have the earned value computation. Now, how do you compute the earned value? That is the value of the work actually completed till date. Value of work completed till date in terms of original cost. That's the most important factor here. In terms of the original budget. So what does this means is that original budget, as per the original budget, the cost should have been how much? For 10%, it's supposed to be $1 million into 10%. Okay, That's supposed to be $100,000. So if you compare the fact over here, its earned value means how much is the percentage completed till date. Actual percentage is 10%. And how much was the budgeted cost for the actual completion? That's $100,000. Okay, so that is what the concept of earned value is. Now we're going to compute the variances over here of the variances. And we had two variances, if you remember, cost variance and schedule variance. First is the cost variance. Now cost variance is equal to your earned value minus your actual cost. Here you're trying to define what is the deviation from the cost which are supposed to be incurred for 10% versus the cost incurred actually for 10%. So that's going to be equal to 100,000 minus $120,000. That's equal to a negative $20,000, right? So this is how you come to know what is the status of the project in terms of cost. In terms of cost, they have already exceeded 20,000, overspent 20,000 compared to the planned amount. Now we're going to go for the scheduled variance. That is equal to your earned value minus your planned value. So now you're going to go for earned value minus planned value. That is equal to $100,000. What does this means is that in terms of the schedule, you are supposed to incur an expense of $200,000 till date by completing 20% of the contract. But till now, you only completed 10% of the contract whose standard cost is $100,000. So in terms of the schedule variance, you're lagging behind literally half of the value which are supposed to be accomplished. The cost which are supposed to be incurred till now is only half of what has been done till now. So these are the two important variances for the earned value analysis. Now we're going to go ahead and look at the theoretical part because there's some more which needs to be understood, and that is efficiency indicators for the earned value analysis. Till now we just seen what is the difference, but okay, we are lagging in terms of cost. We are 20,000, we have spent extra 20,000. In terms of the schedule variance, we are $100,000 behind the expenses as compared to the original plan. How do you define it? How do you derive a useful meaning out of that thing? And that is done by this efficiency indicators, which is cost performance index and the schedule performance index. Let's look at an example, and also along the example we're going to understand what is meant by this variance index, efficiency variances. This cost variance and the schedule variance, they can be converted to the efficiency indicators to reflect the cost and schedule performance of the project. So firstly, it's going to be, we're going to start with a fresh over here, efficiency indicators. First, we're going to study the CPI, that is cost performance index. Okay, cost performance index is equal to earned value divided by the actual cost over here. So what does the cost performance index indicates? It indicates that what is the efficiency with which the costs are being incurred to complete the project. Okay, the CPI is known as generally to enable the entity to forecast the cost to complete the project, and the schedule performance index SPI is equal to your earned value divided by your planned value. And the schedule performance index enables the entity to indicate by what time is the company behind its schedule, by when will it complete the project, what is the expected time to complete the project. We're going to understand this thing in more depth with the help of continuing the example from the previous session from here itself. Over here, a cost performance index is equal to earned value, that is $100,000, divided by the actual cost, that is $120,000. Okay, that is equal to 83333. Okay, that's equal to 0.83. Okay, similarly we can interpret a compute for the schedule value, that is going to be somewhere like 100,000 divided by 200,000. So that is equal to 0.5. Okay, now how do you derive the meaning from these two indices? These two efficiency indicators. Over here, the cost performance index. This means that for every $1 spent by the company, every $1 spent, the project is producing output worth only 83 cents. Okay, so here for every dollar the company is spending, the project is only producing an output of 83% compared to the every dollar spent. So to complete the project, which was for let's say $100,000, $1 million, right? You're gonna need an additional amount to fulfill this project. Okay, so that's gonna be how that's computed easily. It's gonna be 1 million divided by 0.83. That's gonna be, you're gonna need an amount of $1.2,004,819 to reach the milestone, to reach the project cost of, to cover the project cost of $100,000, $1 million. And how do you cross check the answer? It's simple enough. You just take this amount and multiply it by 83 cents. Okay, here you have a $1 million. Okay, so that means you're gonna overshoot the project cost by $204,819. That's what the cost performance index means, and that's what we had told in the initial step, that this cost performance index CPI enables the entity to forecast how much cost will it incur to complete the project till its ends. Okay, similarly we can interpret the SPI, that is the schedule performance index. Now the schedule performance index is at 0.5 over here. This means that for every hour spent on the project, it is generating an productive output of only 0.5 hours, that is worth 30 minutes. Okay, so this means that for every hour of work the company is paying up, they are only able to recover and time, in terms of time, only 30 minutes of work for every 1 hour of work. Okay, for every $1 they're going to be able to recover only 50% of the value of that 1 hour, $1. That is how you estimate the schedule performance index. How much behind are you delivering? Okay, to precise, please say, you can say that the project is running 50% behind its scheduled targets. Okay, that's how the schedule performance index is measured, and it can also be verified by the very fact that entity had to reach a 20% milestone at the end of the first month, but it had only reached a 10% milestone, only completed 10%. That's a clear indicator that the project was only 50% completed till the first month, and that's also validated by this SPI, schedule performance index. So that was all, guys, with regard to the earned value analysis. Make sure you understand this concept very thoroughly, because as a manager, as an ongoing project, you are liable to answer all this question. Why is the project behind schedule? Why is the cost being incurred extra? Where is it that your estimates have gone wrong? How do you improvise on that? Will it take care itself in the future that initial phase pay cost incurred was more compared to the later phase of the project? Will the delay in the time schedules be coped up, or will it need to be dropped down? Will you need additional resources? There are many questions which can come up, but if you have a thorough knowledge of this earned value analysis, that is how to evaluate a project on an ongoing basis, an existing project, you can be sure that you're going to have a sufficient timeline to save yourself, your project, and your reputation also, guys. That was all with regard to the earned value analysis.